The RBI's Monetary Policy Committee meets from June 3 to June 5, and while most economists expect no change in interest rates, markets will be watching closely. Why? Because the real issue is no longer inflation, it's oil. The RBI is widely expected to keep the repo rate unchanged at 5.25%. After all, retail inflation stood at just 3.48% in April, below the central bank's 4% target. So on the surface, there is little reason to raise rates. But the conflict in West Asia has changed the equation. Brent crude remains sharply above pre-conflict levels, raising concerns about future inflation and slower economic growth. For an oil-importing country like India, that creates a difficult balancing act. So what should investors watch? First, the RBI's inflation forecast. Any upward revision could signal concern about rising fuel costs feeding into prices. Second, its growth forecast. Higher energy costs could weigh on consumption and business activity. And third, the RBI's commentary on future rate moves. Most economists expect rates to remain unchanged this week. But if the central bank sounds more concerned about inflation risks, markets could begin pricing in the possibility of rate hikes later this year. That's why this policy is less about what the RBI does now and more about what it signals next. Follow Business Standard for more such stories.